Okay, folks, we are going to get started if you don't mind. So a sincere welcome to everybody for another IMAP luncheon. Happy New Year 2025. Woohoo. We are delighted to have several things. So I'll introduce Jesse in a second. But first, have a bunch of you back. It's good to see some familiar faces again. Thank you again for coming. We have a couple of folks that came from PRI. Many of you know PRI is a big entity in terms of what they do and their interest in understanding things such as climate change and this type of topic area. So always a delight to have you folks here, and look forward to doing many things like we did back in the fall semester. We did a monthly event, which was really fantastic. So I'm Eddie Riedel. I'm the head of this IMAP program, took over from Nalin about October. And we're delighted to have Jesse Chan. Jesse is in our accounting department here at Questrom, does a ton of research in the general area of environmental reporting and whatnot. You can see the topic. I'm going to let him introduce his own topic. He's doing this project, and it's a neat joint work. And Jesse, the floor is yours. So
thanks.
Thank you for presenting.
So it's a new year. And so the thing on my mind is it's time to do my tax returns. And so this seems like a timely topic. Also, certainly, we probably have some tax reform coming down the line this year. We had a lot of tax reform related to this topic in the past couple years. So this is kind of a hot topic amongst policymakers and for the relevant firms. So co-authored with a PhD student, Darcy Fisher, who is interviewing today. So sending good vibes her way. But this is, so our joint work is about energy investment tax credits and their outcome. And so what sort of outcomes do these investment tax credits help to support? And we are going to specifically study electric utilities for several reasons. I actually knew very little about how electric utilities worked. I knew a little bit about power markets, but I learned a lot about utilities just from this setting. Darcy's an expert on energy accounting and how to think about the accounting issues in public utilities, and so she's been great at helping to move the project forward, helping teach me a lot about this particular space, because it is a very exciting space underneath kind of this layer of this very seemingly boring industry. There's actually a lot going on in electric utilities that's really exciting from multiple dimensions. Okay, so why did we decide to focus on electric utilities? Well, kind of at a first order level, when we were starting this project, we were thinking about, okay, more broadly, if we want to study how these investment tax credits affect outcomes, right? We could study it for a large variety of firms. We chose to focus specifically on electric utilities for a couple of reasons. One, they are a big source of emissions, right? So they, of course, produce a lot of scope 1 emissions. They are also, by design, a lot of other people's scope 2 emissions. So we thought that was important. I think too. So this chart is just to illustrate that power utilities directly are responsible for a lot of our emissions, which intuitively makes sense if you think about the role that power utilities play in society and our economy. A lot of our emissions are concentrated there, right? So, okay, second, when we think about where most of our emissions are coming from and kind of who are individual top emitters from a pollution perspective. So this is a great ranking by a team at UMass that ranks kind of firms by emissions. And these top 5 firms are all power utilities, or have power utilities in their portfolio. Like if we think about Berkshire Hathaway, number 4 there is a consolidated holding company with a lot of interests. They also control a lot of power facilities. And so these are all firms in our sample. So it seemed like if we were going to want to study how these tax credits affected firms' behavior from an environmental lens, these are the firms where we'd want to look, right? Since they're directly responsible for a lot of emissions. The second reason we decided to focus on these firms is the specific tax credit we chose to study. So this is a very complicated chart, but there's really 2 takeaways here. One is that the investment tax credit has been around for a long time. So dating back to this chart starts at 2006, but it actually dates back well into the 80s and 90s in various forms. And 2, that the investment tax credit continues to be this policy mechanism to try and encourage investment. So if we look at kind of in this 2023 to 2033 column here, the investment tax credit, even though it's been around for a long time, its prominence in helping to shape operating behavior and its role in policymaking is growing. And we think about the Inflation Reduction Act took the investment tax credit and added a bunch of additional components and provisions to it to try and incentivize specific sub behaviors within the broader goal of investment in new energy infrastructure. The other thing is in yellow or in orange here underneath, you'll see this production tax credit, and that's to illustrate that there's also a separate tax credit regime that a utility can choose to pursue, or a power generation facility can choose to pursue. And there's some interesting trade-offs that we don't fully explore in our setting, but there is a choice on behalf of the utility to decide which credit regime to pursue for a particular power project. Yeah, so this is mainly to illustrate that the investment tax credit has played and will continue to play a prominent role in trying to shape our energy policy. And so kind of we focus on kind of the area in the gray and before, where the investment tax credit was relatively simple and didn't have a lot of additional provisions for domestic content or being in an energy community or other additional provisions as well. But that's coming for sure. So summarizing all this together, so this is a nice overview of what we're trying to do. Is our motivation here is these utilities are a big deal when it comes to emissions, first of all. Second, this is an important part of our economy. If we think about where we generate our electricity, how we generate our electricity. I'm somebody who used to live in Texas, and so learning about Texas's unique power markets and power dynamics and how that affects Texas residents, it was really fascinating to live through. And so it kind of reinforced the notion that these are really important businesses that we often don't think about. These firms are also the target of a bunch of these tax incentives like the ITC and the PTC to motivate this transition to lower emitting or lower carbon emission sources of producing electricity. And so our research question is going to focus on, okay, great. So we have these firms that are very high profile in terms of their emissions, in terms of their environmental impact. We have these policy instruments that are specifically targeted towards these firms to motivate them to reduce their carbon footprint and their carbon emissions. What's interesting is when we were looking around, we were like, okay, let's try and understand how these energy investment tax credits affected these firms' behavior. So kind of at a high level, it might seem, oh yeah, that seems like a pretty normal question. And what's interesting is we did see some research out there that studies the production tax credit, so that orange regime at the bottom of the previous slide, but we didn't see anything that studied that blue regime. And if we think about this chart, this blue regime is where there's a lot of complexity and nuance coming down the line. And so we figured that it would be interesting for us to try and learn about how this investment tax credit or that blue regime has performed to date. So our setting is going to be from 2001 to 2022, so specifically pre-Inflation Reduction Act, to try and simplify some of the moving pieces here. There's still a lot of moving parts, and we're going to study how the decision to take these credits or not affect power utilities, electricity generation decisions, and their emissions. Okay, so what is the investment tax credit? So I've talked a little bit about it and kind of its goal, but these are a material tax credit. So the US government estimates that they're going to spend $60 billion on this tax credit going forward. Of course, that's always subject to policy changes between now and then, but that's kind of the rough estimate in 2021. And we put the child tax credit number here as a comparison, just to show that it's pretty material, how much the country spends on these credits relative to this very salient and very well-known tax credit out there. Because I'm sure, kind of before I got really deep into this setting, I actually did not know a whole lot about these energy investment tax credits. So, and the way these tax credits work is you're awarded a credit as a percentage of your eligible basis or your eligible investment in these projects. So it's somewhere between 10 and 30%. And whether you get 10% or 30% or some number in between will depend based on the year that you're claiming the credit. It'll depend on the technology that you're investing in, so the source fuel. And in the future, this will also vary along other dimensions of the project, including domestic content, labor apprenticeship rules, etc. But in our setting, it's primarily varying based on what year you choose to take it and what type of power generation technology you're investing in, with some projects eligible, some projects ineligible, and the differing amounts based on the type of project.
Gypsy,
Yes,
these are all federal tax credits, or is it
Yes.
state, or do those two interact, complement each other, substitute for each other?
yeah, so these are all federal credits in terms of what we study. Certainly there can also be state credits that layer on top of this, but our focus here is going to be the federal version of these energy investment tax credits. Yeah. Yes.
Is this something that in the whole period that you say they've existed, has this been like stable across different administrations, or has it been politicized?
It's been fairly stable until more recently. Sometimes the types of technologies that are included can shift during certain windows based on priorities of those administrations. But if we think about, so I think this credit dates back to 1986 and kind of the Reagan era tax reforms. Since then, right, we've had Bush Senior, Clinton, Bush Jr., Obama, Trump 1, and Joe Biden, right? And so I think across that window, they've actually been fairly stable in terms of its availability. And then there's sometimes varying technologies, like some technologies were only eligible during certain years and other technologies were eligible the whole window, because this comes from Congress. And so there is some stability to that over our window. And our decision, we're actually going to try and abstract away from some of these like changes, from these small kind of detailed changes from year to year, by primarily focusing on the broader decision of whether or not to use these credits at all. But that's a great question, because as we think about moving forward, and we think about tax reform this year, it's highly likely that there's going to be a big conversation over these credits, even if people don't realize it, right? So that'll be pretty interesting to see what happens. I think in the more recent years with the Inflation Reduction Act, I think the increase in some of these bonuses for domestic content, locating a project in an energy community, I think that kind of opens the door a little bit to maybe some of these more political conversations that'll probably be happening this year as we think about tax reform. But you'll notice before the Inflation Reduction Act, they're relatively simple in terms of just base credit. And so there's kind of less of that politicization, because Republicans want to incentivize domestic energy production, Democrats want to incentivize clean energy production historically, and so typically that has come together in the power utility setting. I think in our setting it's pretty difficult, so we are going to try and zero in on the choice to take the credit by looking at what happens in the years immediately following the initial decision to take the credit. We do have, like, we've redesigned kind of our analysis to try and mitigate some of these broader selection issues maybe inherent in the choice to take a credit, but that is one weakness, is that there's all sorts of stuff going on in this setting. And so we've done our best empirically to try and mitigate some of these issues by matching utilities with other utilities. So we're only comparing across utilities. And so if you think about pressure to reduce your emissions across power buyers, then that should affect a lot of utilities in a similar way, we think. But we've tried to abstract away from some of these external forces that may be pushing firms to take certain action to try and focus on the credit. So why utilities? So these credits, I've mentioned this a little bit. So these credits are often targeted at these utilities. And because they're targeted and they're financially, and they relate directly to some of the operating decisions that these utilities take, to us, it seems plausible that these firms, one, would be aware that the ITC exists, and two, that they might be interested in studying, well, should we look into taking some of these and altering our behavior to fit the criteria prescribed by the credit? The other neat thing about studying utilities specifically is also just from an execution perspective, a data constraint. So some of the accounting rules specific to power utilities and how they need to recognize and capitalize the value of these investment tax credits over time allows us to identify who has taken these credits. So when a public utility claims the investment tax credit, it's going to take place. It's an upfront credit, but the IRS requires you to amortize it over a certain period. And then financial reporting rules require you to amortize them over a different period and with a different method. And this book tax difference is captured on the balance sheet and allows us to collect this data from CompuStat and study kind of the decision to take the credit at all. So we're less concerned with the magnitude, although we do eventually study the magnitude of taking these credits. Rather, we use the unique accounting here as just a way to identify who's taking these, because oftentimes, if let's say we didn't have that accounting treatment, firms could take these credits, but we might not see them on the balance sheet. We would just see them show up over time as a reduced tax rate. And so it would be much harder to identify who is actually claiming these. And so that's another huge advantage of our setting from a data perspective. I mean, certainly the big bonus is that this is where we would expect the action to be, but also we see this data on a systematic basis. Okay, so from an academic perspective, I know we have a mix of academic and non-academic audiences out there on Zoom. And so where are we going to try and fit into the academic literature? So there's a nice burgeoning literature studying environmental, social, and governance issues and the real consequences of sustainability reporting. And so I think we fit in here by trying to think about, okay, what are the real effects of various ESG-related policies? We also relate to this tax literature. So there's some tax literature that studies the real effects of different tax policy initiatives, including carbon taxes, emissions taxes. There's also another burgeoning literature that studies the signaling value of these credits. So when a firm chooses to take certain tax credits, does that tell you something about the firm's strategy over and above the economic value of the credit itself? And so we think our study fits into that literature as well. And of course, a broader environmental economics literature about the economic consequences of various environmental regulations and initiatives. Okay, yeah, so we're going to fit in, framed another way, our study focuses on whether this environmentally motivated tax subsidy affects firms' operating outcomes. Okay, so you might say, okay, well, this makes sense, but like, shouldn't it be pretty, like, why would we have this tax subsidy if we didn't think it would change outcomes, right? Like, in other words, it should be pretty obvious that it does change outcomes, right? And so the idea is that the subsidy shifts the economic, and so kind of under that thinking, the idea is that the subsidy shifts the cost of producing clean energy relative to polluting energy and incentivizes people to pursue these projects. But on the flip side, we were thinking, well, there is a potential setting where these investment tax credits, even though they're out there and they're a big policymaker tool, they may have no net effect in the sense of there's all sorts of other energy policy that's going on at the same time, right? So the incremental value of these tax credits in terms of affecting behavior could be relatively minimal at ex ante when we were thinking about it. And also the way that this tax credit is designed and the fact that it prescribes investments in specific technologies, specifically a lot of solar-based technologies, part of our thinking is, well, maybe this actually tips the scale into certain types of projects over others, even if other projects might be more efficient at reducing emissions. And so at first glance, we were like, oh, this is obvious. It should affect operating decisions and reduce emissions. But as we sat down and thought about it, we're like, well, maybe this isn't quite as obvious as we thought. And so that's kind of our thinking along that dimension. So we've tried to distinguish across them by taking a power utility that does take the ITC and try and compare it with a similar utility or a cohort of similar utilities who never use an ITC at all during our sample period. So we've tried to do that, but of course, the acknowledgement here is, real life is messy. There could be all sorts of reasons why these other utilities chose not to take the ITC at all, right? Maybe they found investments in these projects naturally very compelling and didn't need the tax credit. Maybe they chose the production tax credit, right? So I think we've thought about this a little bit. I think we've tried to do a few things, right? And so certainly we want to acknowledge that there could be there are imperfections in our design. So we're not necessarily studying kind of a core experiment here where we give one power utility the credit and we take an identical utility and don't give them the credit and then study their investment decisions. But we've tried to mitigate that as best as we can. And we hope that there's still some insight that we can gather from this admittedly imperfect study of treatment and control utilities. Yes.
But were there any kind of patterns? I think if I understood it correctly, it was roughly like 20% of the sample were taking the
Yes
credits. So like, was there anything even that you could think kind of qualitatively, like they tended to be in certain states where there were, renewable energy mandates, or they tended to be older companies, younger companies? I don't know, was there any kind of qualitative thing that you could see as a pattern?
Yeah, so we actually did have a determinants analysis that's not in the presentation, where we tried to study, what kind of characteristics affect it. And we did see, I think it tended to be larger utilities. It tended to be utilities with lower ROA who had been around longer. And so to us, what that spoke to us is like there is some complexity in choosing to take this credit that's required. And also sometimes these might be some firms that maybe for whom the economic benefit and getting a rebate on the cost basis is pretty material. If you think about having a slightly lower ROA than their peers, right? So we had some evidence on that. Nothing mentioned. I wish I'd put it in the presentation, but we did do a determinants analysis to try and study what factors are associated with choosing to take this in the first place. Okay, so then our research question it kind of follows naturally, right? And so kind of what happens after firms start taking these investment tax credits relative to their non-claiming peers? Okay, so how do we do this? So we're going to start with data over roughly 20 years, pre-Inflation Reduction Act, and we're going to combine data from the EPA Greenhouse Gas Reporting Program, the Energy Information Administration around power generation capacity at each facility by generation fuel type, and then we will also combine it with data from Thomson Reuters Refinitiv and some additional analyses. So collecting the sample, I think when we started this project, we thought it was pretty straightforward. And then as we got into it, it got a little harder. So we started by saying, okay, let's try and identify all of these utilities using industry classifications. And then we got the question, well, what about firms that maybe generate electricity but just don't happen to fall into these industry codes? So we did this extensive textual-based search where we searched financial statement filings for firms that mention investment tax credits. We read these 10Ks to identify which of these firms are mentioning the energy investment tax credit as opposed to any state credits or different credits. And then we go and look for all firms in those industries that also generate electricity. So after all this work, we actually in the end didn't add that many firms. We did add some. We added about 33 firms, but we didn't add as much as we had liked. But that also gave us some comfort that when we first start with just broad industry codes for utilities, that we've captured kind of a reasonable chunk of the firms that are consuming these credits and pursuing them. Yes. My understanding is we do not necessarily see data on who's purchasing all the power from these utilities. That is probably, there might be some settings where that's possible. I'm not sure. It's an intriguing thought. If there is a power market where this is possible, I want to say it would be the Texas market, but Texas is kind of an independent power market with its own regulatory and market dynamics because it's it's organized very differently than the rest of the country, is my understanding. So if there is a market where we could observe it in a public exchange, it would be Texas, I think. But right now, we can't see where the electricity goes. We just see where it originates, where it's generated from. But that's an intriguing question. Yes. Oftentimes, these are independent solar producers. So somebody might create a company that says, I'm just going to take a field, plop a ton of solar panels in them, connect it to, say, the Texas energy grid, because Texas is a open market, and then sell it into the Texas wholesale market. So with some of these firms, sometimes we do end up finding like subsidiaries of other firms, because power utilities will often report financial statements separately for each sub because they need it for regulatory requirements. So a really good example is Southern Company. They report separately for Alabama Power, Georgia Power, et cetera. And so we remove those duplicate observations in the next step. And that's why our sample falls back down. But in terms of these other firms, it's a lot of these independent solar producers or independent wind producers that put up 2 turbines and then connect it to the grid and sell it into a wholesale power market.
Yeah, that's great.
Yeah, which during our sample period, I mean, there probably was some of that. It probably won't be as extensive as it will be going forward, right, over the next 10 or 15 years. Yeah, but we did try to incorporate that as much as we could, based on what we could see. The other challenge is a lot of these like independent power producers, they're private firms. So we lose them when we try to gather like CompuStat data or like financial statement data on them. Yeah, yes.
Yeah, actually, just to follow up on that, that's a good point. How much of this, it's hard to, what you've undertaken is really complicated because these investor-owned utilities are oftentimes just utility holding companies with assets, regulated and unregulated assets across multiple states, right? So a couple of questions. One, were you trying to control for investor-owned utilities that had assets concentrated in a certain state and only on the generation side and not on the poles and wire side, meaning on the pure regulated side?
Okay.
And 2, if you've got an independent power producer, whose counterparty or off-taker is the investor-owned utility that you've identified, are they monetizing the ITC? Who's monetizing the ITC in that regard?
Okay, yeah, so I'll tackle the first question based on what I know, and I'll caveat this by saying that I think I know just enough to be dangerous. So I went to a electricity markets conference a couple of weeks ago, and then within 10 minutes, I realized I do not know as much about electricity markets as I thought I did one day ago. But to your first question.
And not to interrupt you, but the
Yeah.
ERCOT, the Texas market, is replicated across the country in different pockets, including where we live right now.
Okay.
It's called the New England ISO.
Okay.
So New England, New York.
That's helpful. Yeah.
Atlantic, California, Government West. There's a bunch of these pockets besides her.
Yeah, that's really helpful. Yeah, because I had always understood ERCOT to be kind of a one-off, kind of its own, but yeah, but that's good to know that there's pieces of it. Sure.
But it's not the only competitive power market that exists.
Okay. Yeah, that's really helpful. So yeah, I think to the first question, what we've tried to do is we are going to look at the most consolidated level we can. So for some utilities, that does mean like some are just generation firms, some are generation and transmission. We've tried to consolidate all the way to the parent. So there is going to be some difference in that. I mean, our research is mostly focused on the generation side. And so to the extent that we're picking up some activity on transmission, we're hoping it doesn't too dramatically affect what we're trying to do in terms of measuring generation decisions. And then I forgot your second question.
It was about monetizing.
Oh,
so like if you're an independent power producer and you're developing a solar project, but your counterparty or your off-taker happens to be a utility, is the utility monetizing that ITC, or is it going to the power producer on their balance sheet and then transferring somehow to the counterparty in that transaction? It's complex.
Yeah, our understanding, and Darcy knows a little bit more details about the transferability of the tax credit. Our understanding is what we're measuring is what is captured by whoever is the firm that is generating the electricity. So we end up like, if you're a firm that generates the electricity, but somehow it passes to somebody else where it ends up not on your balance sheet, we're probably not capturing you. So we're capturing firms that generate and retain the ITC for themselves. that's another reason we choose to study pre-IRA. So pre-IRA, the transferability rules were not as loose. So I think in IRA, my understanding is we've made it easier to transfer these credits to try and encourage firms to, even if you don't have a tax balance due, you could still take it and make it easier to sell versus having to set up specific kind of joint ventures or partnerships to and get investors that way. That's my understanding of that. I think it's a space where the more days I work in it, the more I realize the less that I seem to know. Because there's just so much nuance
I've worked in it for
in
20 years.
power market.
I still learn something.
Okay, well, that makes it feel a little better. So, because it's, yeah, and I think that's what makes it so fascinating. The more that I look at it, the more complex and fun it is, because sometimes there's some interesting things in that complexity. But yeah. So thank you. Yeah, no, those are good questions. I think for what we're trying to do, and so then one hard part is how do we try and distill some of that complexity into a 30 or 35 page manuscript. And it's hard. And so, yeah, so, but these are all very good points and that we should try and think about in terms of when we're going to write the paper. So the credit itself, it's kind of mechanical. So it's between 10 and 30% of your eligible cost basis of a project. So yeah, so it's let's say you go to the IRS and you say, I have this $1 million project, right? Then kind of based on the criteria, you would get somewhere between, and what time you're doing it in, you would get between 100,000 and 300,000 of that back as a credit, amortized over. The IRS itself has an amortization window, and then there's a separate amortization window under US GAAP for financial reporting. Yes, and so we are using the US GAAP window because that's what we observe. But we are mainly, and the tricky part with the specific account that we're using to measure is that, let's say you have a project this year for $1 million, and let's say you get 30%, so your tax credit is $300,000. I think the US GAAP amortization window is the useful life of the project. So let's say it's 30 years. But then let's say next year I start a new project and I get another $300,000, then that gets added to the balance. And so there's a net increase in the balance, but we can't disentangle how much is that increase from starting the new project versus a decrease from amortizing previous year's projects. Because we had at some point tried to do more with the amounts, and then we realized it's very challenging to try and back out unless you're keeping very careful track of the amortization windows on each project. So we decided to try and abstract back as just like the initial decision to go from 0 to 300,000, what that means. Yeah. Because it is pretty sticky. Once you start taking it, of course, you have 30 years to amortize, or some amount of years to amortize it for financial reporting. But as you staple on new projects, you kind of keep expanding that window. So once you start, you see it a lot. It depends on the year, and it depends on the technology of the project. And while we can't see directly which projects are attached to the ITC, we might be able to, I guess, infer it or try and guess at it. Yeah. But yeah, that's a good point.
You know the percent that the company gets?
By technology, we know. Yeah.
But the company doesn't say we got 20%.
No, the company just reports one. This is our total amount we have left to amortize of our ITC for financial reporting purposes. Yeah, I'm sure they know, like they're very closely keeping track of this, but yeah. But unfortunately, it gets rolled up before we can see it. Okay, so how are we going to try and kind of distill what we're trying to do into a tractable empirical analysis? So we're going to use a stacked cohort differences design. So the idea here is different utilities are going to start using the ITC at different times. So let's say we have 3 utilities. One starts in 2002, one starts in 2010, and one starts in 2014. So for each of these three utilities, what we're going to say is, okay, let's go and compare what happened to each of these utilities in the 1, 2, 3, 4 years after adoption. So it's a rolling window based on when you started taking the ITC. Then we're going to say, great, now that we've established your windows, let's go and find a comparable utility that never took an ITC at all. Like we don't see an ITC balance at all in our data. And then let's compare your outcomes. So everybody's a rate regulated utility. But one has never taken the ITC and one has started taking the ITC, and we will compare outcomes kind of surrounding ITC adoption staggered across firms. So then we're going to, and the idea is we're going to compare in these different windows, these different pairs of, I think actually we match with more than one control firm, but these different sets of these different cohorts of utilities to try and estimate the effect. So what are we going to study? So our independent variable is going to be, do you start taking, like when do you start like the initiation of taking an ITC? So what are we going to study as the outcome? So we're going to look at a variety of different outcomes. One is electricity generation overall. How much electricity do you generate from renewable sources, non-renewable sources, and also subclassified by a couple common fuel types. So wind, solar, we group up several kind of smaller types of fuel into this other renewables category, natural gas and coal. We'll also look at emissions, so carbon emissions and emissions intensity, so just emissions scaled by how much electricity you generated. And then we'll also look at some other operational outcomes. So to the extent that these tax credits are not just about clean energy, but also about domestic investment, supporting local jobs, right? We'll look at capital expenditures, how much plant property and equipment you have, employees, and also some tax outcomes. So did you end up paying lower taxes on a cash basis and on a GAAP basis? We'll study that too. And to supplement everything, we also wanted to explore, okay, great. So whatever effect is going on, do ESG ratings capture something here? Are the ESG ratings agencies looking at this? And that's not a main part of our analyses. We just thought that would be interesting to explore and see if there was an effect. Okay, so we looked at a lot of outcomes. So this is a summary, and then we'll dive into each one. So what we observed is that after taking the ITC, ITC firms actually produce less electricity from renewable sources, which was kind of counterintuitive to our thinking and took us a lot of time to think through. They're going to generate less electricity from wind and other renewables, but more from solar. Their emissions do go down on an absolute basis, but their emissions per megawatt hour increase. So it kind of depends on your yardstick there for measurement. We do observe some immediate increase in your plant property and equipment, which makes sense, but then it kind of trails off, and an increase in the number of employees. So to the extent that policymakers were interested in also stimulating local employment, right? That could be one positive upside of this program. The utilities that claimed these ITCs did pay lower cash taxes. So that was also actually, we view it as a bit of a validation test that we're accurately capturing firms taking the ITC, because the expectation is if you take an ITC and you get an immediate tax benefit to some degree, your cash, all else equal, your cash taxes paid should decrease. We also interestingly see that ESG scores drop after firms take the ITC. I wouldn't go so far as to say bad news, but I would say that sometimes there are, because of, and especially if you look at the first two results together, a lot of the ITC provisions are targeted towards solar. I think the way that we think about it is there were maybe some unintended consequences as a result of the way the policy was put together. Yes.
Yeah,
Yes.
I'm sure you have said this somewhere, and I just
No.
missed it, but like, you're looking at what, at 5 years after?
Yeah, each year. So a firm.
Each year. So I mean, would you expect, but if these are credits to like start a new project where you're going to capitalize the expenses, so would you even expect anything to change immediately? Because not built yet, right? Like,
Right, yeah, so that's a good question. So I think some of it depends on the time frame it takes to get built. Some projects will come together faster than others. There is some variation. I mean, that's kind of why we looked at 5 years and not just like the immediate 1,
so
2
usually these
years.
Things are built.
Yeah, I think that's my understanding. There probably is some variation based on the project.
More like 5 years.
Yeah,
Like 5 years. That would be more.
Okay.
average. A 2-year build would be like.
Really fast.
Yeah.
Okay, so it might be interesting in future research to look at what happens after
Further,
5 years.
yeah.
Okay.
Yeah, well, yeah, one issue that we're gonna run into empirically with looking like kind of beyond the 5-year window is then you start introducing all sorts of other economic factors that might be happening. So it gets messy, but that's a good suggestion that maybe we should be looking. So right now we look at plus minus 5 years to kind of see the trend, but maybe we're capturing the tail end of that, so we should be looking further out. Yes,
Again, maybe I missed this, but are you looking at capacity or production?
we're looking at production. One version where we paired it based on utility size, ROA, and a few other factors, and we get about the same. So that's a good point about geography, because sometimes it's just inherently difficult to match, right? Like if you think about somebody like a Southern company, they're predominantly in the South. Well, if they're the predominant power generator and deliverer in the South, kind of by design, it's kind of hard to match Southern company with somebody. Yeah. Yeah. And so I think we have a couple competing issues here. One is that like we have, by the time we got down to the end, we didn't have that many utilities that we were working with to try and match. And so we just tried to match with as many people as we could, recognizing that there are going to be inherent differences in like the geographic footprint, the customer base, et cetera, of these different utilities as a function of where they are in the country. So part of what we're hoping for is just like across the sample that it kind of washes out, but we recognize that that's probably a fairly strong assumption. Yes,
Would you mind just going back one second?
Sure.
Because this is a really interesting point. Your point number 2, where wind and other renewables down and solar is up.
Mhm.
So that's not surprising at all to me.
Okay.
Reason why is that the ITC is specifically, I mean, when we talk about it, it's primarily designed to incentivize the production of solar.
Sure. Yeah.
And solar, compared to every other fuel type or generation resource, has what's called the lowest capacity factor.
Mhm.
So
Okay.
that means that for what you install on the ground versus the amount of generation in terms of megawatt hours you get out of it, it has the least. So
Okay.
roughly around 28%, 30%, whereas nuclear is at 90%, right?
Okay.
So it's 90% efficient, whereas solar is like 30% efficient.
And
Okay.
when,
Wind is, depending on the resource, like in West Texas, West Texas, I guess, it's gonna be higher than that, but it's generally higher than that because you're talking about, scale is much
Right.
larger, right? So it's a higher capacity factor. So solar has the lowest. So in order to offset that, not only is it intermittent,
Mhm.
obviously it's intermittent. In order to complete that intermittency and maintain electricity online, you have to add firm power. And firm power is usually added by natural gas. So if solar goes up, you generally tend to see solar go up as well as natural gas production go up as well. They complement each other.
okay.
So you see that very often. You see it right here in New England. You see it in California. You see the more solar that comes online, the more gas that comes online as well to firm it up when solar is not online. So I'm just pointing that out.
Oh,
for
no,
you.
no, this is helpful because
I
this,
think because that makes total sense to me. Even
Okay.
though that might be confounding
okay.
to others, like
Right.
that absolutely makes sense.
No, that's really helpful because we're like rewriting it because, trying to explain why we might
And I don't mean to
be observing
overthink
this.
it.
No, this is really good.
Context.
No, this is good. Especially as we try to so like, it's always interesting to think about kind of like when we think about writing this paper for an accounting audience, I think most of our audience is like me. When I started the project, I was like, I would have expected to see more renewables, just more renewables, lower emissions, and then case closed. And so some of this nuance is actually really, really helpful. And I think for us, it's a double-edged sword because it made our paper really compelling to a lot of people, but then also it's very difficult to, I guess, articulate why this might be happening. So that's really helpful. And also it gives me some comfort that that this set of results makes ties together. Because sometimes you see what seems like a conflicting result to you, and then you're like, okay, why is this? Did you do something wrong? And so this is really good as like a validation check for ourselves. Yeah. And I think it speaks to maybe some of the, like, if we think about some of the policymakers that built this, right? I'm sure there were probably some electricity market or electricity experts there, but it probably wasn't everybody, right? So, and so this can be helpful, especially as we think about with our current set of tax regimes, this doubling down and increased use of the IRA, or of the ITC, although there are a lot of changes to the ITC with the IRA, to our understanding, that might help address some of these issues, in the sense that it's not tied to specific, it's less tied to specific technology is our understanding. But still, like, I think helpful to document these patterns. Yeah. Yes.
Just a kind of related question. So are most utilities, when they take these ITCs, is this an expansion play or a substitution play? Meaning I'm a utility and I generate whatever 1,000 megawatts, whatever. Just try to swap something in or out, or I'm trying to grow my base. And tied to this.
Yeah, that's a good question. So if we think about figure 1 here, we see renewable generation in the aggregate come down, but non-renewable generation kind of stays about the same. It maybe comes down a little bit, but it's noisy. And so I think to us, it doesn't necessarily seem like it's an expansion play. So if we look at our tables here, we see that overall generation is coming down a little bit, but noisily, but it's really the renewable generation to the point about efficiency. If you're substituting away from wind into solar, you may have this, I guess, at a very for me, the way I think about it is, let's say you have one specific plot of land, you have a bunch of windmills there. If you tore out the windmills and put solar, you are going to generate from that same plot of land, even though you've taken a tax credit for it. So there's a lot of things going on here, I think, and I think we're something that we continue to try and learn from every day. And so it's kind of why we workshop papers and learn from them. But so we see renewable generation comes down, which we think is a function of this generation efficiency of solar versus other renewables. We also see total emissions come down a little bit, but emissions per megawatt hour goes up to the point of like thinking about, okay, maybe we reduce our absolute emissions, but we're generating less electricity from that solar, and end up having to use a little more gas to get to the same total electricity. Or emissions per megawatt hour could go up. Yes, I think that's an open question. I think the way the tax credit works is for tax reporting purposes. There is, I think it's roughly a 5-year amortization window. So kind of like once you get it up and running, you've already got it, right? So you might as well hang on to it. You might not replant the same technology when that technology kind of ages out. So my understanding is the credit is based on how much you spent on the project. And so if you spent a lot of money, right, if you built a massive solar farm, then maybe it's kind of linear. So probably your net incentive to keep it online is going to be pretty similar to what you had previously, I think. But no, that's an interesting question to think about. It's kind of to the earlier question about this long run consequences, like beyond 5 years. So, oh, it is 1:26, so I have 4 minutes. But I think this is the core result here. So there's, so I'm glad that we made it to the summary, but I'll fast forward to our conclusion and we can leave time at the end for some questions, or if we want to have an open discussion. I think this is a fascinating area. I still am trying to learn about this area as much as I can. But the takeaway is, so once you take an ITC, you generate less renewable electricity relative to your pre-ITC generation levels. And this appears to wind and other renewables to solar, which is consistent with ITC incentivizes. Importantly, though, it's not all bad news. Firms that take the ITC employ a lot more people. So to the extent that you view the ITC as a tool to promote local employment, to promote job creation, especially in communities where there is power generation, there is that nice benefit there. Your ESG ratings drop. And so where do we contribute? You know, we're hoping to add to this conversation about tax credits and influencing utilities behavior, especially as the ITC becomes a bigger part of the Inflation Reduction Act and as a cornerstone tool of the IRA at incentivizing behavior. We also think our results contribute a bit to how we can use tax credit information as a leading indicator of sustainability outcomes. And as we're thinking about the ITC, or how do we want to incentivize or not incentivize renewable electricity production, we're hoping we have a little bit to add to that conversation, especially for as a non-expert, especially for a non-expert population in this area.